This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hedinger. Next on News Radio 102.5 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans. Or you can talk to him right now at 407-916-5400.
Good morning, ladies and gentlemen. Welcome to the program Dollars and Cents. My name is Joel Garris with Nelson Financial Planning. And for the next hour here on News Radio 102.5 WFLA, it is Central Florida's longest-running radio program, Dollars and Cents, where we help you make sense out of all of those different decisions that we encounter every day that have anything and everything to do with your dollars. The format of the show hasn't changed in 30 years, as has a lot of the information that we share with you. Some fundamental truths still exist about investing and your money and your taxes and your retirement and educating your kids, et cetera, et cetera. The reality is that many of those things, in terms of the approach, really haven't fundamentally changed at their very core. So today on the program, we will be talking about a variety of things, as we typically do. We'll talk about health savings accounts. Those are getting more and more interest, and frankly, I think they should have probably have gotten more interest over time. Now they are sort of coming more into their own as people are constantly looking for ways to help reduce the cost of health care. The health savings account, what makes it really unique is that it is a triple tax-free retirement investment vehicle. A triple tax-free. We'll talk about what that means on the program. And then we will also talk about an article that we posted on social media this past week. An interesting article that, given the number of times that we chat with people in the office and they say things like, I'm not sure what I'm going to do in retirement, or I'm getting bored, or I've got too much time. We'll talk about some of the hobbies you might be able to engage in to help you spend that time in retirement. Those are those are certainly one of the most popular books in our lobby. Is a book that we bought a couple of years ago, and it is 100 retirement hobbies or 100 things that you can do in retirement, I think is the exact title of it. So something a little fun on the program today, but certainly addresses a question that we do get. So we'll give you some ideas and some things to think about as well on that. And of course, a couple of follow-up items we'll start with from last week's show. This past week was the tax filing deadline. And if you recall the conversation last week on the program, last Sunday, of course, was April 15th, which meant that the actual filing deadline was going to be the next day because the deadline can't fall on a Sunday. So that meant it was April the 16th. And then, lo and behold, that was a holiday in the District of Columbia. So that shifted it to the 17th. Well, wouldn't you know it? It got shifted to the 18th as a result of a computer malfunction by the IRS itself. So I don't know if you saw that headline or not, but I kind of had to chuckle a little bit that the IRS's computers melted down on the due date. And I understand that it's a busy day at the IRS, but I don't know that their computers should melt down to the point where they're not able to accept tax returns. But because of that, they extended the deadline an extra day. So if you were a day late or if you thought you were a day late on your taxes, don't worry, you weren't, because the actual deadline wound up being April the 18th this year because of that computer meltdown at the IRS. Also this past week, at the start of corporate earnings season, we talked a little bit about that last week on the program as well. Some of the early results are in, or at least for 20% of the companies out there. They've posted their results another week ahead with a lot of earnings as well coming up. But very strong start to the earnings season. So of those 20 companies that reported earnings this past week, the revenue growth or the earnings growth was 18% on average. Stop and think about that number. 18% earnings growth. Now, interestingly, now we're starting to see some of the tax cuts that were slated for 2018. We're starting to see some of those now show up on the profit and losses of these big companies. One of the misconceptions is that the tax changes that occurred at the end of last year had an effect in 2017, and they didn't. So the tax return you just completed doesn't have any of those changes on it. All of those changes, whether you're a business or whether you're a corporation or whether you're an individual, those changes were for 2018. So 2018, now that we're in 2018, and this is the first quarter, or these are the earnings reporting from the first quarter of 2018, then this earnings season represents the first time that those tax cuts are in the numbers. And what's interesting is that it looks like, again, early on, so we're about a fifth of the way through. Earnings season really kicks into high gear this week, where you'll have a lot more companies kind of coming out with their earnings along the way as this coming week progresses. So the tax cuts effectively looks like it's adding, according to some calculations, it's adding over 7% to the bottom line of these earnings. So perhaps some of the early analysis on the effect of these tax cuts probably looks so far that the benefit of them may very well have been underestimated in terms of their impact on earnings, because you're seeing, as you look at these results, where it's made a difference of over 7% in terms of the bottom line, and that is obviously contributing to this big increase in earnings. So we continue to keep an eye on those numbers. The 2018 tax cuts are finally showing themselves for the first time, because this is the earnings announcements of the first quarter of 2018. So because of that, it looks like some of the early analysis that was done kind of underestimated what the impact of these tax changes would be. It looks like these tax changes are actually going to be adding over 7% to the bottom line, which is pretty good. We'll see if that trend kind of continues this week as you get more and more into earnings season. But certainly earnings growth at 18% year over year is a pretty significant number. That's a quite a big jump from 1 year ago in terms of getting to that 18% earnings growth. So some interesting numbers on that. Our next topic we'll shift over to is going to be the health savings accounts. These are really powerful vehicles to not just help you with healthcare expenses, but also the triple tax-free treatment of these vehicles is, and they've been around a long time. And I think for many years they were largely ignored, and I think that was unfortunate. I think there was a lot of missed opportunity where folks could have been using these as an option for their healthcare needs. So we will get into all of those details about health savings accounts right after this break here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning. We also have open lines, as we do during the course of the show, so feel free to give us a call, 407-916-5400, toll free 1-855-545-1025. We'll be back after these messages.
iHeartRadio is the easy-to-use app for music and radio. Download the free iHeartRadio app today.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents. Was just listening to those traffic reports earlier in the program. And my goodness, I-4 is just a mess. Okay, you're closed going eastbound where you got to get off, and then westbound there's like 2 accidents on just what I saw on the drive into the show this morning. So good luck getting around in Central Florida today. The traffic looks like it's a little heavy out there with accidents and road closures and all those kinds of things going on. Anyway, this segment of the program, we're going to talk a lot about health savings accounts. We've also got open lines, so we'll give out the numbers. It's 407-916-5400, toll free 1-855-545-1025. Health savings account, the only triple tax-free retirement investment vehicle that works for your health expenses. Why triple tax-free? Here's how powerful these things are. And look, they've been around for a long time, but really have been overlooked for many years until just recently. But they were always available as an option, and it is unfortunate that folks did not take advantage of them when they first came out. They first came out almost 15, 20 years ago in terms of when they were first made available by the Internal Revenue Service. So here's how that triple tax-free piece works. So you put a contribution in, and you get a tax deduction for it. Okay, so that's great. Put money in, and you're allowed to just take a direct write-off on your tax return. So that works very well. The biggest amount you can do for 2018 as an individual is $3,450 or $6,900 for a family. If you're over age 55, you can kick in an extra $1,000. So that would be $4,450, or for a family, that number would be $7,900. So decent amounts that you can actually put in there and then turn around and get a tax deduction for those contributions. While the money is sitting in there, you don't have to worry about paying tax or on any of the earnings or the interest or anything like that, because it is tax deferred. So not only it's tax deductible, it's tax deferred, and when you use it for qualified medical expenses, you can take the money out without any taxes. So stop and think about that. It's tax deductible. It earns on a tax deferred basis, meaning you don't have to pay along the way. And then when you take it out, it's tax free. I mean, doesn't really get any better than that, right? I mean, that's like taking the features of an IRA and combining it with the features of a Roth. Put the money in on a pre-tax basis. It grows tax deferred. And then when you take it out, it's got to be for medical expenses, but it's tax free. I mean, that is a huge benefit and a very powerful vehicle to address those healthcare costs that are just rising at just crazy rates. And it's been around a long time, and not a lot of people have been using it, but we're seeing the usage of it start to take hold more and more. It's certainly a very good option, particularly with those features. I mean, you don't find something that is triple tax-free like that very often. Here's the other part of it, okay? So if when you turn age 65, if there's money in there, you can take money out at age 65 regardless of what you're using it for. I mean, you don't even have to use it for medical or health related expense. Now that is going to be subject to income tax, but that allows you access because one of the benefits of a health savings account, and this is where I think the confusion comes into play, is a lot of people get them confused with flex accounts. Flex accounts are pre-tax contributions that you can then avoid the tax on that money when you use it for certain types of expenses. So, but the problem with your flex account is you have to use it all up by the end of the year. Otherwise, you lose the remaining balance. So, and I think that's one of the confusing points that people think about when we're talking about a health savings account, is they have that misconception that the money has all got to be used by the end of the year. And that's not the case with a health savings account. You can, in fact, roll that balance over on a continuous basis. So you're not going to lose the value of those dollars. So it's really beyond just the tax savings of it. The reality is that you don't lose that money at any point in time. And even at age 65, if for some reason you can't come up with enough health expenses, which be surprised, I mean, that's great if you're not. At 65, you can then use it for whatever else you want to use it for. At that point, you have to pay the taxes on it. But that is a pretty flexible vehicle that provides access to money for health-related expenses. The other part of a health savings account is that it goes in, you're allowed to put it in before the FICA and other income taxes kick in. So you can really get that money in to a health savings account right off the, sort of right out of the gate, right off the top line. The other piece of the health savings account is that you can also, when it's family coverage, you can use that to pay expenses of your spouse or a child, even if they are covered under another medical plan. So if you've got a health savings account, it can be used for anybody, even if they're totally on a different plan. You can still use that money in the health savings account to pay for the expenses of other family members, even though they may not be part of your health savings account plan. So it's really pretty flexible in terms of being able to use that money. Now, in order to have a health savings account, you have to have a qualified high deductible health plan. Now, it's got to be a qualified high deductible health plan, and not just not just a regular plan that just has a high deductible. There has to be a specific type of health insurance that you have that works hand in hand with the health savings account. You can't just set up a health savings account on your own if you feel like it. You have to have the type of health insurance plan that provides options or access to a health savings account, because the health savings account can only be used in conjunction with a qualified high deductible health plan. So make sure you're asking that question. If you want to set up a health savings account, you have to make sure that your health insurance plan is of the right version to be able to do that. And then with that health insurance plan, then you're able to integrate the health savings account with it. Now, one of the key things about the health savings account, as with anything that you're doing, is it's important to kind of keep a paper trail of what you're using those expenses for in order to back up the fact that you're using it for medical expenses. So that's always smart to do anyway, but particularly here where you may have to come back later on and prove that, yes, I did use that money for medical expenses. It's always good to keep the receipts on that, because the health savings account you can actually use to repay yourself when you spend money out of pocket. You can use the health savings account to kind of repay yourself, but you've got to save those receipts in order to justify that approach. In addition, unlike retirement account or traditional retirement account, where you've got to take the money out at age 70 and a half, there's no required minimum distribution or anything like that on these accounts. They literally can keep rolling for as long as you want. So the options and the flexibility are really pretty great. And here's the thing. There is no income limits or restrictions or phase outs or anything like that at all. I mean, you could literally be making $1 million a year and contribute to a health savings account and get the tax deduction and get the ability to use this type of an account with that triple tax-free retirement approach. So that's pretty powerful stuff when you stop and think about it. That isn't phased out. I mean, so often you run into, I can't do an IRA because my income or my employer had a plan, or if my income gets too high, I can't even do a Roth. There's none of that applies here. None of that applies on a health savings account. There's no income limits. There's no restrictions on that. You're able to do it. You're able to take a tax deduction. Pretty powerful stuff that I think has not been discussed or as readily suggested to the public as other options. And this option has been around a long time. And I think had more people been doing this since it's been around 15, 20 years, there would be a lot more folks who may be able to better tackle their health care costs had this been known or a little bit more well known. But that's why we're talking about it here on the program, right? Because we would encourage you to set up a health savings account. Look at your health insurance. Make sure it's a high deductible type of health insurance plan that allows you to have a health savings account, but then take the next step and set up a health savings account. We'll have some more thoughts on health savings accounts, but we're going to slide to the break here at the bottom of the hour. You're listening to Dollars and Cents. This is Joel Garris here on News Radio 102.5 WFLA.
UFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 102.5 WFLA. On our friends over on the AM dial, we're simulcasting on 540 AM. On the program today, we're talking a little bit about health savings account. We've also got open lines at 407-916-5400. Toll free 1-855-545-1025. Those are the numbers to call on in and be a part of the program. We're talking a lot about health savings account, a vehicle that for many years was overlooked by many people as a viable option for helping to address this ever-increasing cost of healthcare and medical-related expenses. And the power of the health savings account as a triple tax-free retirement investment vehicle is just not fully understood by many, which is, of course, why we are talking about on the program today, is to try and educate and get out information more about these options, because they've been around for 15, 20 years, but not many people have used them. I think the biggest factor is this confusion that it operates much like a flex spending account, where you have to use the money by the end of the year, or otherwise you lose that. Health savings accounts don't act that way at all. Any remaining balance rolls over from one year to the next. So you get to put the money in on a tax-deductible basis. You don't have to pay taxes on it along the way. And when you take it out for medical expenses, it's tax-free. And in terms of funding, you can fund it up to the tax filing deadline of April 15th, or in the case of this year, it's actually turned into April 18th because the IRS didn't really have its computers working. But that's a lot of flexibility to be able to fund that account right up until the deadline. So you don't even really need to fund it during the course of the calendar year. You can wait and fund it right up until the official tax filing deadline of that April 15th, or however they adjust the date in years ahead. So there's a lot of flexibility in terms of when you can make the contribution. And there's no income limits either. So much of this stuff, when we look at tax returns where folks are earning a significant amount of income, you'd start to lose a lot of the benefits or the credits or the deductions that are generally available to you. With a health savings account, there's no such limit. I mean, you can take it and you can write it off no matter what. So pretty powerful alternative in terms of being able to save money for your healthcare expenses. And even at 65, when you turn 65, you can use it for non-medical, but you have to pay the taxes on the earnings. Along the way, the catch, of course, is that if you do use it under the age of 65, then if you use it for non-medical expenses, then that's when you're going to get hit with not just income tax, but the penalty on that is higher than the penalty on, say, an IRA. There's an additional tax penalty of 20%. So there is a structure to these that really encourages the right behavior, in that you've got to use that type of an account for qualified medical expenses. Otherwise, it's not just taxable as ordinary income to you, but there's also a 20% penalty on top of that. So be aware of that part of it, that it's certainly not a cookie jar. If you use it as that before age 65, then you're going to be hit with not just income tax, but also a 20% penalty. So the costs there are going to would be pretty significant indeed. But certainly, health savings account, check that out. If you're shopping around or trying to figure out your health care choices and looking for a health insurance, see about getting a health insurance plan that is qualified to have a health savings account with it. You can't just go and randomly open up a health savings account. You have to have the right type of health insurance plan in order to be able to integrate in a health savings account. But certainly a very, very powerful option for folks in terms of trying to save for their health-related expenses, and then to be able to have that money and to have it carrying forward is obviously some great flexibility and some great tax benefits. So be sure and check that out the next time you're shopping around for health insurance. So one of the most read books in our lobby at the office is this book we bought a couple of years ago that has 100 things to do in retirement. And some of them are kind of a little tongue-in-cheek. Some of them are a little off-color. But the notion of the book is to open up some choices or some thoughts as to what you're going to actually be doing in retirement. I had an opportunity to actually talk to a neighbor a little bit yesterday, and retiring next week and planning a extended trip throughout Europe. Certainly, travel is a big hobby in terms of what people like to do in retirement. But hobbying, some hobbies, or should I say, traveling, is on the expensive side of things, right? I mean, when you travel, you're going to spend money. So one of the things about the book in the lobby, and also the same article that we posted on social media the other day, is to find some ways to spend your time in retirement that are fulfilling, that are enjoyable, and perhaps don't cost money, because it's great if you've got the money to be able to spend on travel and things like that, but perhaps you are trying to do things and follow a little bit of a budget, so you can't travel every day, 365 days a year. So to expand and expand your horizons and to look at options, we thought that the article that we posted on our social media stuff, our Facebook and Twitter and Facebook, Twitter, and what's the other one we do? LinkedIn is the other one we do. Those types of platforms was an interesting article to quote. And some of the things, just if you want to read the article more, then obviously you can find it on our Facebook page. But some of the things obviously are pretty self-evident. But volunteering is a very good option. Participating in a book club, walking, hiking. Many folks do that. Gardening. Photography, genealogy, all kinds of options to be able to enjoy your retirement while not having to spend a lot of money. Always good to travel and to be able to spend money and enjoy and things like that. But, if you're like most people, you don't have unlimited resources, and so you want to try and operate on a budget, and to the extent then that you've got that free time in retirement, try and look for enjoyable things to do that don't necessarily cost money. And certainly there's some great options. And the book in the lobby at the office has some good suggestions. And then we thought the article that we posted on social media the other day also did. So check that out. We will slide to the break. We get back from the break. We'll be in our last segment of the program. My goodness, how time flies here on the program. So join us for our last segment. We've also, of course, got open lines at 407 916-5400, toll free 1-855-545-1025. Those are the numbers to call on in and be a part of the program here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning here on News Radio 102.5 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on 540 AM News Radio 102.5 WFLA. We are in our last segment of the program. We're going to have a couple of different statistics to chew on, particularly relating to taxes and then also retirement plans at work. So here we go. So the results are in. The last tax year that the data is available is the year 2015. But to rank in the top 1%, you had to have adjusted gross income of $480,000. Rank in the top 5%, you had to have adjusted gross income $195,000. Rank in the top 10%, adjusted gross income of $138,000. And then the rank in the top 25%, you had to have adjusted gross income of $79,000. So those numbers are the numbers for tax year 2015. So congratulations if you're in that top 1%. That's pretty good. The reality is in the top 25%, you just had to have adjusted gross income in excess of roughly about $80,000. So some interesting numbers out on that. How did that group shake out in terms of how they paid? Well, that top 5% number, the folks with adjusted gross income over about $196,000, paid more taxes during that tax year 2015, paid more in federal income taxes than the rest of the 95%. So the top 5% paid $866 billion in income taxes. The rest of the folks, the other 95%, paid $588 billion. So, lest you hear the argument that we don't have a highly progressive tax structure in this country, perhaps you can share these statistics with anybody who suggests that. You've got the top 5% of taxpayers paying more than the rest of the population and paying considerably more, $866 billion versus $588 billion. So the top 5% clearly carrying their weight, particularly when you have such a progressive tax structure like ours, meaning the more money you make, the higher the tax rate is on it. Top 5% paying more than the other 95%. And to rank in the top 5%, certainly that's a pretty decent level of income, above $196,000. But that group is clearly putting a whole lot of money into the system, certainly paying their share, if you will. So I don't want to get too political on that commentary, but hopefully you catch the drift. Anyway, 71% of Americans have access to a retirement contribution plan at work, whether that's a 401k or a 403b or a 457 or any similar type of retirement vehicle. 71% have access to a retirement plan through work. So that means for the vast majority, or at least 71%, your primary option for saving for retirement is what your employer is offering to you. So it never ceases to amaze me how little folks sort of know about whether their employer offers a plan or whether they don't, what the match is, or if they're matching or not. It always amazes me at the lack of information that many folks have with respect to their employer plan. But 7 out of 10 Americans have a plan at their employer, so we encourage you to ask your employer more about the option that may be available to you. Here's the point that we want to make with that statistic. More and more, we are seeing these employer-provided retirement plans, 401ks, 403bs, and the like, really going to a low-fee, low-cost, plain vanilla type of approach. And that's understandable because as a business, they're trying to minimize the cost and looking for the cheapest cost provider on it, because there is cost when you offer that benefit. But here's the point of that. As they go to that, then it's becoming more and more automated. And the investment options that you have to pick within that 401k are getting more and more target or cookie cutter based types of approaches. So our word of caution on that is make sure you really look at what the underlying allocation is for the investment choice that you're using, because what we're finding in time and time again is that the allocation formulas or the target date series of funds that you will see proliferating throughout employer-sponsored plans have a tendency to vary widely in the allocation that those funds have internally. So you can look at one 20-30 fund and maybe see 80% on the stock side. You can look at another 20-30 target date fund, and you would say, well, they've got to be pretty close to the same. But that one may be only 60% on the stock side, and that's a pretty big gulf for what is self-described as targeting the same year. So what you've really got to do with your employer plan is really take a moment and look under the hood on these sort of automated investment options, because there's a tendency of that automation to bend much more on the conservative side, meaning that you're going to have much more on the cash and bond side of the allocation than many people realize. So be aware of those options that are becoming more and more prolific in employer plans, and make sure that you are sort of looking under the hood and looking at that underlying investment allocation that exists, because you may be surprised that it's not as growth oriented as you want. So particularly with the proliferation of these more automated, more target date, more allocation types of approaches, those types of approaches have an underlying allocation underneath them that really bears you checking that out and getting the right information in order to make the best decision, rather than just going with sort of the automated option. So a couple of interesting comments and stats here in the last segment. Hope you enjoyed the show. We will post it, as we do, on the various social media channels during the course of tomorrow. And we will, of course, be back next week here on the program, Dollars and Cents. Thanks for listening. This is Joel Garris of Nelson Financial Planning. You're on News Radio 102.5 WFLA.
This is Bud Hettinger, and you've been listening to Dollars and Cents with Joel Garris of Nelson Financial Planning. If you missed any part of today's show or want to listen to it again, check out the radio show at www.nelsonfinancialplanning.com or connect with them on Facebook or Twitter. Be sure to call Joel this week at 407-629-6477.
How have your investments performed over the past 5 years? Do you know? Are you happy with that number? At Nelson Financial Planning, we've been achieving investment results over the past 30 years using actively managed investments that we own personally. This is Joel Garris, and I invite you to review your investment results with us. Visit NelsonFinancialPlanning.com or call us today at 407-629-6477 to set up a conversation to review your investment performance. That's NelsonFinancialPlanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC at FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 102.5 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.